my core framework, which has been we are still in a disinflationary world, and that interest rate rises are self-limiting because everybody's too indebted and the aging population, and that trend in bond yields, I call the chart of truth, where bond yields go down over time, holds. That is currently the least popular view from most people. Everybody, and I've interviewed everybody that I know and really respect. I just did an interview with James Aitken, Gerard Minack, Kirill Sokolov. They've all changed their macro view. They're like, structurally, we think there's long-term inflation. And their view is, we think there's long-term inflation because of the amount of spending that will happen to transition to ESG, and there's not enough commodities to deal with that. Absolutely true. That supply chains are coming back to regionalized, so people need to build new factories. And I think that's true too. I still think that the demographic story is larger and that demand for commodities is driven by the economy itself. And so I know it's fiscal stimulus, but at the margin, if households spend less, then price of commodities comes lower. I think overall, I still think commodities come lower than here. The big question for me, I think we're headed towards recession. Now, again, as ever, everyone's saying, well, this time it's different. The forward part of the twos curve doesn't suggest interest rate cuts. The 3-month, 10-year is not inverted. There's always but this time. I generally look at all the forward-looking indicators that I've been using for the last 20 years. Most of them are weakening, showing weakening growth. I don't have many things that give me a recession yet. It kind of feels like 2006, where the yield curve remained inverted for a period of time before the actual bad news comes.
Or what leads you to believe that we are going to go into, or at least growth is going to weaken substantially if it's not an outright recession? Is it just the natural course of the economy? Has it been happening already, or is it because of the Federal Reserve?
No, it's happened because of commodity prices. What we've had is a massive tightening of monetary conditions because wages have gone up 5% and inflation's gone up 7.5%. So what you've done is destroyed demand by 2.5%. So that basically, if the trend rate of growth is 2.5%, you've just gone to zero. So I see that in inventories to new orders in ISM. That relationship suggests that the economy is headed to pretty close to recession. I look at shipping, freight, all of these indicators, the year-on-year rate of change, they've all gone to recessionary levels. So something's going on. Consumer sentiment, the University of Michigan's consumer sentiment indicator is recession levels. It's consistent with the yield curve. Small business optimism, falling, not yet at recession levels. ISM new orders, falling, not yet at recession levels. The ECRI year-on-year survey, the Economic Research Cycles Institute, that is, again, pretty low, near zero. So there's a lot of indicators that are like, listen, ISM is likely to get down to between 52 and 50 between June and July, something like that. Usually the Fed stops when that happens.
So gold is pretty straightforward. It trades like shit, but over time, there is a very strong case for other central banks to increase their reserves in gold because of the fact that gold is nobody's liability and the dollar now clearly is. So I think that creates a secular backdrop. The other outcome, I think, that if I'm right about global economic weakness coming, there will be more rounds monetary stimulus, but maybe in clever ways, i.e. handing it out to people who can't afford their electricity bills, but it's still the same bloody thing. Or yield curve control, still the same thing. So that debasement of the denominator, the value of fiat currency, means that gold automatically rises. So I'm pretty positive gold, but it just doesn't trade well. It's kind of weird. It keeps trying to break higher and then fails and tries to break higher and fails. So that keeps me from being very allocated towards it. And I think, cryptocurrencies are actually a much better bet for this. In terms of the bond market, I've just put out a tweet thread about this morning, is there is a 35-year channel I call the chart of truth, where 10-year bond yields go up and down in this regression channel. And when you get to the top of the channel, it's usually the end of the cycle. And the end of the cycle, yields are lower every time because more debt gets added to the economy every time yields go down. So therefore, a smaller rise in yields breaks the economy and things slow down. And also demographic demand As the population ages, they tend to buy more bonds because it gives them security in retirement. That's another big factor. Demographics tend to slow down the trend rate of growth, so that brings that. So this chart is a meaningful thing. It's not just a chart of an asset. It's actually a big secular framework of understanding of where the world is. So we're right at the top, poking through the top of the channel. We poked through in 2018 and everyone said inflation's going to 6%. What happened was growth started falling. And usually the yield curve inverts when that chart is at its peak. And that's exactly what's happening now. So this looks like every single other cycle I've ever seen, where everybody gets excited about breaking the channel. Everyone goes, everything's changed. The yield curve inverts, and everyone goes, forget the yield curve. It doesn't mean anything. And it plays out. So I'm, more of a buyer than bonds. I bought some call options on bonds, but I will probably over the next few months look, because I think growth means lower yields.
And then let's move to equities and commodities. What are you seeing there?
Equities, I thought they based a week or so ago, based on a number of technical signals that I have. Also, I looked at the chart pattern of equities around Fed rate rises or reduction in the balance sheet. And they basically form the same kind of W pattern every time and then rally and go to new highs. So I'm like, is this any different? Probably not. And that's been every single one over the last 20 years has done the same. The only one that was slightly different was 2018, and that's when the yield curve had just inverted and we had a liquidity shock. So I've thought there is a 60% probability the market just goes up, and there's a 40% probability we have another shock lower based on whatever it could be. Let's say scenario 2 in the Russian scenario might cause that, and then we might see liquidity in markets dry up, and that the market could then be starting to price in the recession. We don't know when recession comes after a yield curve. It can be almost immediate, or it can be 2 years away.
I don't think so, because I think demand has been destroyed already. And, mortgage rates have gone up a lot. We're seeing housing market cooling down. So all the things you'd expect to see are happening. So, I think the moment, oil's has been coming off, and it's still kind of a bit sideways-ish, but if it breaks much lower than, let's say, 95, it could go back down to 80, and that takes a lot of pressure off. Wheat as well. I did the work on the stocks-to-use ratio of wheat, excluding China's massive stock of wheat. It's still pretty high. It's as high as it's been in the last 20 years. So as long as we don't have a terrible harvest in wheat, we're not going to run out of food. So I think that the market might have over-extrapolated the trend. And I think that if the ISM comes down to somewhere close to 50 by the summer, the Fed might have done another 50 basis points or 75 basis points, but they're going to say, well, let's just watch and wait and see. Now, we saw this playbook in 2016. The Fed were like, yep, we're going to raise rates 4 times this year. They raised once and then didn't do anything for over a year. So let's wait and see. I think because the yield curve is later in the cycle, unlike 2016, I don't think they come back again and start raising. If they stop, they stop.